Okay, well, 10 years ago this week, still in the throes of the financial crisis, U.S. stocks would bottom, with the S&P 500 sinking to the 666 level. A decade later, stocks have more than quadrupled. For more on all of this, Yahoo Finance's Jared Blikre joins us from the newsroom. And Jared, looking back, I got to imagine there's something that stands out to you.
Yeah, well, we almost didn't have a 10-year bull market. We had two periods, and one in 2011, one just last year, where the market crashed over 20% on an intraday basis. Now, we measured the official bull markets and bear markets usually on a closing basis, so we narrowly escaped those. But putting that aside, going back 10 years on that 666 low in the S&P 500, it would be only about a week later that the Federal Reserve would announce QE1 in all its force, $1.7 trillion in large-scale asset purchases in treasuries and mortgage-backed securities, and that was totally underappreciated at the time. I remember I was with a group of what I consider to be savvy trading friends, and we just kind of overlooked it, and it wouldn't be until months later that we really came to understand that the Fed was a market. If you look at the Fed's balance sheet over time, it was only about $900 million just before the financial crisis, and then it ballooned into $4.5 trillion. Now we have what's been going on called quantitative tightening, and we wound down about $500 billion or so. But there is a lot to go, and it looks like the Fed is going to be on hold as of the end of this year. Another thing that I would say stands out, interest rates. The 10-year rate, which had been averaging 4 to 5% before the financial crisis, it's sunk to an eventual low of 1.6%, and that was only 2.5 years ago. Nobody really would have expected that, especially with ballooning budget deficits. A lot of people were calling for a secular rise in long-term interest rates, which we still have yet to see.
You know, Jared, one other thing that strikes me as we approach this anniversary, which technically I believe is on Saturday, is that a few months ago you had this conversation about the longevity of the bull market, right? And that it couldn't possibly continue for much longer because it was so old in traditional bull market terms. That conversation seems to have faded a little bit.
Yeah, and it depends on how you define bull markets.
Right.
I spoke to a lot of traders who have been around for more than 30 years. So going back to the 1980s, they've experienced secular bear markets as well as bull markets. And a lot of them consider, to a striking degree, that we are really only in the middle innings of a secular bull market. And we really saw it take off with the lows of 2016 to where we are today. Even if we were to have a bear market, they would say they expect it to be short-lived because we have so many technologies, from biotech in terms of the CRISPR therapies to the Internet of Things to smart cities, 5G. All this is going to take, at least another probably decade to play out. And so that's why they're long-term bullish, actually secularly bullish in this market right now.
Really interesting. The so-called fourth industrial revolution. Thank you so much, Jared. Appreciate it. I want to bring this to you guys. Tendayi, of course, one of the other things, not just the fourth industrial revolution, one of the other things that's been so supportive to the U.S. markets has been the Fed, right? Yeah. Which is something that Jared alluded to. Have we seen a structural change in the way stock markets work over the past decade?
I think so. I think there's been a huge dampening in volatility for one, and one of the things that's been a feature of this bull market is that stock pickers have had a really hard time outperforming, and I think a lot of that has to do with you have kind of this flood of money essentially from the Fed, which was supporting all asset prices. And the moment they started to pull away from that, we saw that at the end of the last year, we started to get a lot of volatility, and now they've kind of pulled back from that. So I think the Fed really is kind of an outside participant in what happens in the market now, and I'm not sure I'm entirely comfortable with that.
I agree with that. It's interesting. And when Jared was talking about it took time for people to understand the effect that quantitative easing was going to have on the stock market. I mean, it took a few years, actually. And then finally you started seeing charts, analysts saying, look what's happened to the S&P 500 and look at the pace of quantitative easing. And they were just perfectly correlated almost. And the question then was, okay, what happened if the Fed is essentially pushing markets up and risk assets up? What happens when the Fed has to start unwinding this? Is it going to have an equal and opposite reaction, and our market's going to deflate when that happens? We still don't know the answer. We still don't know the answer. I mean,
so far you heard so many dire predictions several years ago. You're going to have runaway inflation with the Fed going to these low levels and pumping liquidity into the system. You're going to have this huge asset bubble that is going to pop. None of those dire predictions have come to fruition.
That's true, but I mean, when we showed the Fed balance sheet, and just as it started to turn was the moment when the volatility returned. And the Fed has barely begun to unload all those extra assets on the balance sheet, and we did get a return of volatility. Now the return of volatility is probably a good thing, because
I was going to say that, because
we need more fear and less complacency.
The unintended consequences of all of this would be, without volatility, we haven't cleared out companies that shouldn't be in business. Yeah. And we've also have a generation of potential investors who do not want to have anything to do with this market.
So I think a little bit, there is millennial participation in the market, right? I think a lot of this, people kind of say, millennials are not in the housing market, they're not in the equity market, they're off eating avocado toast. I think a lot of it, I think it's a bit overplayed. Okay. I think the data does show that there is millennial participation in the market. Probably the bigger challenge is that they haven't experienced a downturn. Which might be a bigger shock to them when that happens.
I don't think we're going to know if quantitative easing worked until we actually get through the next downturn, because we know that if it were to come in within a year or two, the Fed is not going to be able to cut rates as much as it has before. It does not have the headroom to do that. They've already got $4 trillion on the balance sheet. If they have to do quantitative easing again, can you just add to the balance sheet ad infinitum? We really don't know this. We'll find out once we get into and through the next downturn.